let's do a brief overview of credit. What is credit? Well, credit is the mathematical equation representing your ability to repay a loan. How do they figure that out? Well, first you have to know what FICO score is. And how many people know what FICO is? FICO, F-I-C-O, Fair Isaac Corporation. That's right, they're a corporation. They own the algorithms, the proprietary algorithms that are used to determine your credit score. And they sell those algorithms to the companies that use them. And there are three main credit reporting agencies: Equifax, Experian, and TransUnion. And when you take a loan or borrow money, that company most likely will report your payback history, whether good or bad, to Equifax, Experian, and or TransUnion. They might report only to one, and they might report to all three. Once upon a time, the different companies, Experian, Equifax, and TransUnion, were kind of divided between different parts of the country. One for the West Coast, one for the center, and one for the East Coast. And depending on where the lending agency was housed, they would report to the appropriate credit agency. Now that everything's digital, a lot of them just report to all three, or it could be a completely random selection. And that explains why the three different companies will give you three different scores. They're most likely using the same algorithm, but they have different information, where some companies are going to report to all three, some to just one. So you're going to have a mix of different information. So what is the numerical representation of your credit score? Well, it's going to be between 300 and 850, 850 being the gold standard. Once you get above 7, you're doing pretty well. And in terms of the housing market, once you get it to 750, anything above that is just kudos on top, but it isn't going to change what loans you get. So 750 is what you're aiming for in terms of purchasing a home. Now, that isn't to say that you can't purchase a home without that. There are programs that'll go all the way down to 600 and 580, but you do want to get that score as high as possible. Now, what is included in your credit score? Well, nobody knows the exact algorithm. Many companies try to replicate it. Credit Karma is one example of that. With trial and error, they're trying to come up with the best algorithm that best replicates a FICO score. But what goes into it? Well, the biggest part is your positive or negative payback history. How well have you paid back your loans? Has it been on time? Has it been 30 days, 60 days, 90 days behind? Or do you have some delinquencies that are years old? So that's going to be part of the score. Also, how many accounts you have, the number of accounts you have. That can both positively and negatively affect your score. If you have lots of accounts that you have taken a loan and then finished that account, that's going to be a positive thing. If you have an overwhelming number of revolving credit, that could hurt your score. Also, the diversity of the accounts. They want to see a mix of different types of loans. That could be a mix of an auto loan, a school loan, and revolving credit. Also, the time, the history you have with certain accounts. And there's nothing really you can do to improve that other than just time. But that does mean that if you see a better credit card percentage, credit card offer, don't rush to close out the ones you had before. Keep them on hand if you're going to go for that newer one, just so you have some longevity in credit history. Also, in terms of revolving credit, your score is going to be affected by the ratio between the available credit and your balances. And the magic number to remember on this one is 25%, meaning the goal is to have no more than 25% total balances to your total available credit. And that is both on all your credit cards combined as well as each individual one. So that means that if you have 3 or 4 credit cards and you consolidate them all into one, In that one, you might be hurting your score a little bit because that one might have an unfavorable credit ratio between the available credit and the balance. Also, as I mentioned, time. Most credit events or credit on your credit history is going to disappear after 7 years. Now, if you have an account that you've had for 20 years, it'll show up that you've had that account for 20 years. But things in the past, they'll fall off in 7 years. And that is both positive and negative. It can be a negative if those good accounts are then disappearing off of your credit history and you have to keep rebuilding your credit. But it's definitely a positive thing, as delinquencies of the past will eventually just go away. Now, a few quick tips to improving your credit score. Well, it should be obvious. Make sure that all loans and credit cards are paid on time. That's just the best way to improve that credit score. Make sure that you have diversity in credit, that it's not just all revolving credit. You can take out a small loan from the bank, or if you have a car, you can even take a loan out on that car even if you don't have one. It does mean paying it back, but that'll help your credit score. Also, paying down revolving debt. It doesn't necessarily help your credit score to pay down loans that are term loans like student loans or credit or car loans, but paying down revolving debt will definitely help your credit score. And also, as strange as it sounds, for some people, increasing your available credit, meaning asking your credit cards for an increase in the available credit, which can improve that ratio and get you down to 25% of balance versus available credit. Now, it should be noted that if you know that you'll be tempted to use up all that available credit, that's probably not the right tactic for you. But if you know that you can just set it aside and just let your available credit increase, then that can help your credit score a little bit. I hope some of this helps to understand credit. If you have any questions, just give me a call.